Good morning, ladies and gentlemen. Well, the risk dial is slowly ascending. 40, we're in the green. The model is saying basically prefer equities to fixed income. We're risk on again, still in all time frames. And you can actually see that the daily score keeps on improving. It came back slightly from the middle of the week, the best levels, because of volatility increase, but these moving averages are slowly diverging, moving higher, basically saying there is not a lot of danger at the moment. The weeklies are doing well as well. We are ascending, and the monthly, I'm sure, will close with an even better divergence in another week's time. So really not a lot to say from these scores. Remember that these are the compilation of all the thousands and thousands of spreads that I follow, and has nothing to do with the absolute price level. So the spreads are positive and turning more positive, and saying that equities are to be preferred fixed income. In terms of deviations, I mean, it's picture perfect, isn't it? We are just ascending very slowly, very much like this period. Every time it goes into the red, it's basically stop, wait for it to come back, go again. And I don't think that there's going to be much difference this time. The trend is very much your friend, and the trend is very much upwards. Every time, should it ever come down towards the middle line, it's going to be a very good buy. All the levels are always written here, and you'll be able to see them. Just download it on a daily basis and have a look for yourself. Now, why do I comment on this? Because you will see how divergent the sectors are. This is very much a rally which is taking place in basically one sector, which is XLK, and nothing much else. XLE is actually rolling over. Avoid energy is just not something that you want to have a lot of your money in. And even, sectors which previously were doing quite well, like the telecoms and XLU, the utilities, are really doing not much. The metals rolled over with the stronger dollar. And this is it, XLK. XLK is the only one which keeps on making new aggressive highs, and which has a very steep center line. That's the one that's driving. Everything else, XLF, as you can see, just meandering sideways. It's probably going to be a good buy next week if it drops down a little bit more, but you can see it for yourself. This is a very good pictorial representation. XLK followed by XLV, and those are the only sectors which are doing anything much. XLY also is one which is doing so well, but XLY is being driven by Amazon, which, you could argue that belongs in XLK. So really this market stands or falls by the price level in XLK, which is more or less the same as the Qs. Lovely chart. Every time it goes into the red, you get out of it, you wait a few days for it to drop back in, and you buy it, and it just keeps on going up. If XLK and the Qs are not performing, the market itself is going nowhere. Now, some people are very worried by this divergence between XLK and the Qs and the rest of the market, and they think that value against growth is being very mispriced. I am much less worried, and the explanation really comes from the bond market. The bond market is stable. Okay, twos, tens basically meandering between 35 and 53. And I think the central banks are very much aware of these charts and they are trading them. They have a huge bazooka, which is the QE programs that they are undertaking, and I think they are actually undertaking them at price levels. They've stopped really buying every day, and now they are saving their ammo for when the market gets at certain levels. I certainly think now that you will see basically the market remain in this kind of area in the twos, tens, and unless it starts breaking above these previous highs here at 55 basis points, 56, 57 basis points, this is an indication that everything is well and that that trade, i.e. the outperformance of the growth of the things that are have potential growth in earnings, is going to continue, because if you have growth in earnings you can price it at higher multiples if the bond market is absolutely stable. I'll examine that in some more detail now for you. I'm going to show you a series of bond charts to show you exactly what I think the central banks are doing. Now, I haven't moved these price levels by a tick, and you can go and have a look at the previous videos and you will see that they've been there for weeks and weeks and weeks. This is a 5-year bobble, gets to minus 61, boom, QE, straight back down. Now, same thing here for the 10-year, i.e. the Bund, to the tick, boom, QE, back down. So this is Europe. And now I'm going to show you the States, and I think you'll see it's exactly the same story. And this is how I think the central banks are actually managing the market. I think they've got much cleverer than they used to, rather than doing QE day by day by day and really not caring about the price level. Now they're caring about the price level and intervening massively at levels. Yield chart of 30-year bonds. Quo Vadis, absolutely nowhere. To the tick, up here, central banks, boom. Okay, the market priced this in to get in the auctions, got in the auctions, straight back down. Now, if we're going to be stable between 145 in yields and say 115 in yields, i.e. a 30 basis points trading range in 30 years, which I guess is what they price equities off, that gives you certainty, doesn't it? It gives you very much a range in which the bond market is going to be, and then you can reprice your equities according to that yield level. Can now multiples go to 25 times? Absolutely. I mean, why not? Why would multiples not go to 25 times if you have the certainty of a 30-point range in 30-year bonds? I mean, you can then say that equities should be trading at 3% yield, double what you have there, and that's that difference is your equity risk, and still that makes 25 times your 160 level for the 2021 earnings, which you can then discount, and gives you 4,000. So, and it gives you even a lot more for XLK. So what the market is doing is absolutely logical. The market is basically saying, until this range is broken and until I have certainty, I am just going to buy the dip and basically lock in a yield of of much more than twice what the bonds are giving me. Perfectly logical behavior. There's nothing illogical here. This is just maths. makes much more sense to pick up higher yield in equities than try to trade and bust this level here when the central banks are intervening to the tick. It gives you certainty, and certainty gives you higher equity valuations and multiples. And this central bank management of the bond markets is actually coordinated internationally. I refuse to believe that such a tight range between bonds and the US market is accidental. I think they've managed it down here to a level that they're comfortable with, and they are now maintaining it. While the market remains in this range between 100 and 125 basis points, I think the dollar can but be stable at levels, and we will look at DXY and those levels, what the maximum and minimum are. But I think that is actually achieving two aims. A, it's achieving the aim of keeping their bond markets within a very tight trading range, which in turn supports the equity multiples, and also it gives a definite range for the dollar, which again supports equities. They're squeezing volatility basically in everything, and that is what you need to get certainty to people, to give them confidence to invest. I don't think it's coincidence that the dollar is doing what it's doing. It's basically doing a repeat of this pattern here, and I think they are basically trying to manage it between a level around the high 95s and the low 92s. That's a 3% trading range, let's call it that, in the Dixie. I think the odds of trading up towards 95 and change cannot be discounted. That is what they are going to try and do, and I think that while the spread maintains the 110, 115 basis points in favor of the US dollar, it is very difficult to start pushing it below this 92 level. This trend line actually goes, I'm not a great believer in trend lines, but since everyone else looks at them, I might as well have it there. It's been there for over a decade. So to push it through is going to take a move in relative bond yields and relative interest rates, and I don't think the central banks want that, will allow that, and therefore this kind of behavior, certainly what they want to do is maintain a level of confidence in the US dollar. Nobody wants it to go down too fast, and that to me is probably the most likelihood that we go from 92 to 95 back down towards 92, and they try to keep it meandering in that area ahead of the US elections, because they don't, the dollar has the power to set the weather, and if it starts breaking down, that will move up volatility in both the bond markets, and finally that will really make the stock markets much more volatile, and that is not what the central banks want. They want you to trade in very tight predefined ranges and keep the market stable and keep confidence high. As a supporting argument for what I've told you about the Dixie and that it should trade somewhere around 95 again, I think is this chart. Look at these divergences here. From this high to that high, 3 drives higher, 3 lower highs. I think the odds are that in the next 2 or 3 weeks we test the 115.50 area in Euro USD, and what an absolutely wonderful risk reward buy that is going to be. I think it returns straight back to the highs from this 115.50 area, but I think over the course of the next couple of weeks we will see that level again. We can even see, we can put a retracement level all the way from the lows. That won't even be a 38% retracement if we put it from, this kind of level. Here you go. That gives you a just around a 50% retracement of this move. Not unlikely in the slightest. My bids are 115.70 level, and that is where I want to get long, and that should actually equate to that slightly higher than 95 level in Dixie, and then we can go again. What does that imply for gold? Well, it implies actually that everyone's long at the top. This kind of pattern is more likely than not to be repeated. You are likely to see gold down to 1750, 1763, whatever that level is, within $10. Who cares? You are now, I think, likely to see a 50% retracement of this move. At least. That's just below 1800, but possibly here I would have thought is more likely even 1730s, 1740s. It's just there is no reason to be long of gold. The reason was, the dollar's falling, bond yields are melting. No, bond yields are stable. The dollar is stable, having found a lower floor, most probably. That gives you sustained gold prices. It doesn't give you accelerating gold prices. I think both silver and gold have now seen their top and are more likely to test support levels than they are likely to accelerate higher. There is absolutely no reason. The inflation narrative, I think, is rubbish for the time being. It might return, but I don't think it's going to return anytime soon. Not while the central banks are controlling the bond markets in the way they are. Even if people thought that inflation might accelerate, it's going to take an awful long time for that to come true. I think the downside in the metals is far more likely to be tested than the upside. And that is probably your best trade over the next few weeks. Sell the rips in gold and silver or buy some puts. I still think that 1763 is going to be the level that I want to cover my positions at. That is going to be the swing level that I think we find very hard to break through and stay below. I think a repeat of this kind of pattern is really on the cards. These charts actually represent very clearly what is going on in the market. And they're, XLF over XLK, XLV over XLK, XLI over XLK. Basically, the downtrend is just extreme, isn't it? XLK rules the roost, as I showed you in deviations. And basically what is happening is that every time XLK takes a pause, corrects slightly, these sectors take up the rein, correct a little bit upwards. That keeps the averages, the indices, stable. But it then goes again. And it's just remorseless, isn't it? This is a secular trend for higher valuations in technology, for the only thing which has growth and prospects. And it's very simple. The stability of the bond market and the tightness of the range and the low level of the range. I mean, let's face it, the world has never seen 30-year bonds stuck at around 130, 140. And, in Europe stuck around zero. And that is just remorseless. It just draws more and more and more money into the only thing which gives you growth, potentially higher earnings, and also a higher yield than the pathetic yield that you can get in fixed income, and the stability of that yield. Therefore, I don't think this is going to change, but I think every time XLK corrects and Nasdaq corrects, you get a higher level of XLF to compensate for it, keeping the SPX stable. And this is the result. You know, you have an NQ which is powering ahead, and there is no reason to sell it. I don't care how high up it goes. I don't care that, you know, what divergence it creates. It has to. The central banks have to, for this to go lower and stay down. The central banks have got to change what they're doing, and there is absolutely no reason to suspect, and you know, absolutely nothing to suggest that they are going to stop doing the intervention they're doing in the bond markets anytime soon. This is going to take years to change. It's not something that's going to change tomorrow or, you know, next Wednesday magically. So really, shorting NQ and the tech sector before the valuations are at equivalent levels to bonds, i.e. way over 25 times multiples, I think is stupid. It is mathematically, you know, inept. I see absolutely no reason to be worried by anything that happens in NQ unless it starts closing below 11,058. That level is, to me, you know, once it broke, it could never close below, and only break below there, and by that time this moving average will have caught up. That will be my warning, that to look again and see what's happening. But really, unless the bond markets start going out of the ranges that I've just shown you, I think the odds of that happening are almost zero. The rotation into the tech sector is really very clear when you look at what is happening in indices which are not tech heavy, like the DAX, the stocks. Basically they are stuck, going absolutely nowhere. I mean, we are at the same level now as we were 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks ago. Okay, this 11,866 level is holding it very well. Every time it goes 0.5%, 1% above it, there are sellers. And I now think that we are more likely at some stage to give up the ghost in DAX, i.e. people who are long of it are going to say, why have I got my money in this when I could have it in NQ, XLK, whatever is getting growth, and they just dump it. You know, 11,830 is to me more likely than a break and maintaining the break above 12,900. So I think, you know, having some puts in the DAX with low volatility and looking to, you know, cover around this kind of 11,900 level, and having some calls in Nasdaq or QQQ, I think is still the right trade. I think that spread still keeps on going. There is absolutely no reason to think that the DAX is going to outperform the Nasdaq for the foreseeable future. In fact, there's every reason to believe that once the dollar has stabilized around that 95 Dixie level, of come back to 115.70, that spread is really going to start motoring, i.e. lower DAX in relative terms to QQQs or NQ. The Nikkei is doing absolutely the identical thing to DAX. It's just going nowhere. It's exactly where it was 10 weeks ago, much like the DAX. I think the odds are that we see 22,000 again, but I've always preferred the Nikkei to the DAX. And I still think that Nikkei is basically underinvested and has much more potential. But really going to take my clues to the DAX from the Nikkei. I think the Nikkei will lead the DAX, and therefore until that starts breaking and closing above 23,400, I'm not going to touch the DAX from the long side, but I'll be looking to pick it up at those levels which I just mentioned to you. This to me is far more likely to come down and test the lower levels and then go in a few weeks time. So to me it's obvious what the where you should have your money. If you want to invest, it's NQ or the QQQs, followed by SPX, because that is being dragged up by that sector which is constantly higher, followed by Nikkei and Europe in last place. One potentially interesting trade, if you think about it logically, i.e. that the markets which have very little tech in them, the indices, pardon me, which have very little tech in them, and also the dollar that we discussed earlier, that it's more likely to stabilize than not, is actually EEM. It's more likely from this, especially from this 45 level, which is such an important swing level that goes back decades and decades. It finds it very, very hard to break this 45 level. Is on a monthly basis to look for a retracement back down to here, and this gap fill to around 41 and a half. That's a 10% move, you know, so it's well worth thinking about. On Friday I did go short this against some US, thinking that, you know, the odds are good that it comes back down towards this 41 and a half gap fill, certainly on a relative basis to US, while US does nothing. You know, that's the kind of relative play that I like to do, because we are at a very good level. I know that a close above 45 makes me very wrong, and therefore I can cover. But even the EM options are relatively cheap. Buying 45 1 month, 2 month puts, I think is going to pay off very nicely. And this is what happens when sector rotation keeps on happening and there's only one sector that's really going up, i.e. XLK, and all the others are doing nearly bugger all. It's a market which is stable, which can't go down, because XLK, every time it goes down it gets rebounded. Really, I think that all there is to say about SPX is that until it closes below 33.37 there on a weekly basis, there's absolutely nothing to do on the short side. Now, whether it's going to, you know, take out 3,400, get to 3,450 as the top of the Bollinger Band on the weeklies, I mean, it'll only do it if XLK allows it to do it. I think it's more likely that basically we have 1.5% trading ranges for the next several weeks. I think there are so many dangers coming up with the US elections that people are not going to be very, very keen on buying all the sectors which could be vulnerable to a Biden victory or a Democratic sweep of both the presidency and the Senate. That's going to keep people very much on their toes and, you know, have some sort of worry about it, that they're not going to go max long of these other sectors like XLV, which could be impacted, or even XLF. The tax plans that the Democrats have are, you know, all up in the air. Higher taxes are not going to be good for this. So I think it's going to be a slow meander. And really, if you want bang for your buck, you know what you've got to trade. You've got to trade XLK, or you've got to trade the NASDAQ or the Qs. According to deviations, every time it goes into the red, you get the hell out. You wait for a 3-4% retracement, for a couple of days, you buy it again. The levels are very clear, both in Nasdaq and in the SPX. While the market is above these levels, 33, 37, and 10,000 and what was it, 60 or so in the Nasdaq, there's absolutely nothing to do on the downside. So finally, table of support and resistance. You should always follow the 2s, 10s and 5s, 30s because it gives you it sets the mood for everything. So as long as those are between 35 and 55 and very stable, or 120 and 105, there's really nothing going on. It's just, the ebb and flow of normal summer trading. I think from 105 I would like to give the steepener another chance, but I don't think 120 is going to be broken anytime soon now. I think the central banks are just so good at manipulating this that you're really looking to trade probably in size, but for no more than 3-4 basis points. That is what we are reduced to doing. Dixie, I think, this 95.50 to 80 level is going to be very interesting, which should match up with that level of 115.70-ish in Euro USD, and that's what I'm looking for. As a result of all these above, I can't really see that gold can do much better than 2000. And really the danger in gold is to the downside. 1750, I'd love to buy it because I think that would be an exaggeration of the bonds and of the dollar. So that would be my level. I'm not holding my breath. If I see it, great. If I don't, who cares? And for the, I've showed you what I think of the other bond markets. I think they're all going to lag the US and continue. Hello, this is nothing new. To me, 33, 37 is absolutely crucial, as is 11,060. While above, I don't think any of these markets are in any way vulnerable, and the natural resistance only comes at the weekly Bollinger Bands, which are at these levels. I think it's steady as she goes. While this is doing what it's doing, I don't see that these levels can be broken. They can only be broken if these levels here somehow get busted. So that is what you're looking for. You're looking for the bond market to actually break out, which I don't think it will, and therefore as a result I can't see these levels being broken either. Thank you very much indeed, and tweet you on Monday.